Good evening, everyone. Thank you all for joining us tonight. With a very special guest from California, our panel today is on the post-pandemic resilience, challenges, and opportunities for emerging markets and Türkiye. So this panel is organized by SETA, an Ankara-based think tank in Türkiye. And you are all welcome to our panel to discuss these post-pandemic opportunities awaiting countries such as Turkey. We're joined by Professor Aizenman from the USC and the NBER tonight. Professor Aizenman, welcome to our panel.
Thank you very much.
Thank you, Professor. It is actually a great honor to host you tonight. And we are very much excited and eager to hear what you have to say. I would like to briefly introduce Professor Aizenman. Professor Aizenman is a renowned economist from California, an expert on developing world, actually, and on emerging market economies, one of the most cited economists. Professor Aizenman has had consulting positions at the IMF, the World Bank, the Inter-American Development Bank, the Asian Development Bank, and the Federal Reserve Bank of San Francisco. He has worked at UCSC, the Dartmouth College, the Hebrew University, at the University of Chicago Graduate School of Business, UPenn, and he currently serves as Dachshund Chair in Economics and International Relations at USC and a research associate for the NBER. Professor Aizenman's research focuses on a wide range of open economy, macro, commercial, and financial policies, crises in the emerging markets, foreign direct investment, capital controls, and exchange rate regimes. Professor Aizenman, before I leave the stage to you, I would like to start with a very brief intro, very brief introduction.
Sure.
In this new post-pandemic era, national economies, they are dealing with many internal and external dynamics and factors, including the recent inflationary and recessionary trends, rising commodity prices all over the world, war in Ukraine, broken supply chains, the COVID lockdowns, even nowadays, actually. And the world economy, it witnesses shifts in productive economies, supply centers, and logistic lines. And the economic transformation and new paradigms, they are shaping the post-COVID, post-war world economy. National economies, geostrategic, geoeconomic, geopolitical conditions, they are all effectively deciding even the fate of an economy and their macro performances. The COVID-19 outbreak and the opportunities created by the new global economic order in the aftermath of this outbreak, they are, of course, extremely important. And they need to be taken into account, of course. And with that in mind, we are, of course, curious to hear about the post-pandemic resilience and opportunities, challenges for countries such as Turkey. And now, with the great privilege of hosting you, Professor Aizenman, the floor is yours.
Thank you very much for the kind introduction. And this is a quite informal presentation. In fact, I'm sitting in the room of one of my grandkids, and also I delivered this PowerPoint yesterday evening. Nevertheless, the topic is very important, and I would like to focus first on Turkey, my interpretation of challenges and opportunities. And of course, whatever that you will hear reflects on my views and not any of the institutions that I was or I am affiliated. And maybe I'll close by looking at the challenges and opportunities in Asia to give a more globalized perspective of Turkey. And of course, I'd be happy also to try to answer your questions. Feel free, if you have any clarifying question, to ask while I am discussing these transparencies. So looking at the challenges and opportunities, we know that the coordinated effort of first the US to end the quantitative easing and the easy money policy in the context of the inflation triggered also similar effort of the ECB. And of course, once that these forces are unleashed, it impacts practically all countries. First, because the US dollar remains the dominant currency, like it or not. And the ECB and the US together are controlling policies for practically close to maybe, depending on the adjustment of power parity, more than a third of the global economy. So in this situation, most of the countries are forced to adjust their own policies to the new stance of moving towards disinflationary policies of the fashion that appeared roughly from 1979 to 82 of the previous century. So in this context, countries that invested ex ante in generating policy space have options, but a lot of these options are related to trade-offs. So countries with fiscal and monetary space may consider public investment as a compensation for the decline in the aggregate demand, which is associated with the coordinated rise of policy interest rates, which of course is a major step after years where the policy interest rate in the US and in the ECB was very close to what we call zero boundary. So one can think about the case where recessionary forces may be mitigated by infrastructure investment, education, and if the country invests in dealing with global warming, so the infrastructure includes also adjustment to all these challenges. And if the country has monetary space, so then keep in mind that when the inflation is hitting hard the US, and when the dollar prices are going up, this by itself, in the context of a higher interest rate, is generating an adverse effect on the inflation of other countries, because the fair share of the pricing of commodities and manufacturing goods is dollar pricing. So then countries that have reserves may try to adjust the reserve position by mitigating the depreciation of their currency, because the depreciation itself is generating higher inflation propagated by the pricing of traded goods, and some of the propagation is related to related forces. Now, Turkey is constrained in this situation by several factors. First, the funding of current account deficits remains a top priority of Turkey. And in this context, the spreads, what is known as the CDS spreads, which is the cost of, if you wish, insuring against default, this year fluctuates between 5% to 9%, and this implies that external borrowing is expensive, but I believe essential for the future growth of any country that relies at the margin on external funding, as is the case of countries that are running current account deficits. This also implies that the net return from investment is lower due to the risk premium. The unemployment in Turkey has been relatively high even before the present interest rate tightening cycle of the US and the ECB. So let me double check if I can switch to the next. Okay, I see the switching option. I hope that I see. Yeah. So here you can see the report of Bloomberg that goes back half a year ago. And the point is that default insurance is expensive. It fluctuates. In the middle of the year, it appeared to be close to 8%. Now I believe it's closer to 5%. So this is, of course, not unique to Turkey, but if we are talking about aspirations of investing in the future, so this is definitely an issue that constrains the path going forward. Turkey's unemployment remains relatively high. It declined in the past years, but it is about 10%. So in relative terms, it's definitely a challenge for a country that is relatively young in terms of the distribution of the population. And this by itself suggests that if there is a proper policy space, definitely it's proper to do what it takes to increase the employment, preferably in the direction of activities that are offering a high private and social return. Now, I would like to discuss several questions that are here highlighted by the colored font. So the new investment, production, employment, and export-based economy model may help Turkey overcome the middle income trap. So let us hope that this assertion is correct. Let me raise some issues that one should keep in mind. With limited domestic savings, the cost of the investment is constrained by is constraining the benefits of this strategy, as I mentioned before, that if at the margin the funding is associated with relying on external funding, so this funding is quite expensive. Here, it's fair to say that the future has shifted in recent years from manufacturing towards services, with growing returns in IT-backed activities. And let me be clear, there's nothing wrong in manufacturing. But if you're looking at the trend, by now, roughly 70% of the GDP of the average country, and I expect that Turkey is confirming to this, are services. And it's almost what happened in the past 200 years with agriculture. Of course, agriculture is essential for the production of food. But with all the adjustment of new technologies, the relative price of food declined. And chances are that the relative price of manufacturing products is also declining. So the chances are that the growing returns looking forward are related to services that are using IT directly or indirectly. And of course, this may include a huge spectrum starting from education. After all, we are using now a fancy technology that 50 years ago nobody dreamt. Going to the medical system, in the US at least, close to 20% of the GDP is spent on relatively inefficient provision of medical services, inefficient relative to, say, what you see in Western Europe. And chances are that there is a huge scope for adapting IT services in a more efficient way for all countries, including, of course, Turkey. And then manufacturing itself may benefit by using robotic engineering. And then a lot of hope is attached to machine learning, big data, and the like. All this requires greater investment in top human capital and mitigating the brain drain of top engineers and scientists. Of course, this is a global issue. And if you recall, the collapse of the Soviet Union implied that indirectly, several millions of top engineers and scientists prefer to switch their home, moving to Europe, to the US, and to other destinations. I believe that this is a global issue, and of course, you should know better that this applies also probably to Turkey, and as well as to other countries that are doing or used to do a very good job of educating engineers. My limited understanding is that the focus on education of this type may benefit by greater allocation of resources. So let me turn to the next point. Turkey could reposition as a new energy hub, especially in the context of natural gas and the like. Turkey also may be able to have bigger role in the near future in related activities. I think that this is definitely an important point. But here, let us note that this, again, will be related to the cost of funding of these activities. So any policy that will reduce the cost of funding, including hopefully increasing the domestic saving base and maybe reducing the forces that are attributing to the significant relative to other countries risk premium, this definitely will enhance this strategy. Now, here, I would suggest to keep in mind that gas and oil are very important for the coming 5-10 years. But chances are that there are already forces that will mitigate their importance if your horizon is 10-20 years. So maybe the focus should be balanced also with R&D of future technologies. After all, the arrival of electrical propagation of cars, and by now it goes beyond this, is offering new opportunities that will diminish potentially the role of the older type of energies. So I believe that the idea here is correct, but hopefully all countries, including Turkey, should recognize that this is very important for the next 10 years. But if you look at the bottom line, my understanding is that the cars that are using batteries are much more efficient in terms of the present pricing of propagation, and the chances are that they will over time replace the standard old-fashioned cars. Now, one should recognize also that Turkey should recognize that this strategy would require greater cooperation with all its neighboring countries. And of course, this applies to all the neighboring countries that should cooperate with Turkey, because at the end, if you're looking at the big picture, it can be win-win strategy if all the countries in the region are cooperating, or negative sum game otherwise. So this is a challenge to all the countries in the region, and you should be aware that due to various reasons, this by itself is feasible, but it requires investment in good faith from all the relevant partners. So let me move to an attempt to compare the challenges of Turkey to the challenges of other countries in Asia. Now, of course, I'm aware that Turkey is both in Asia and in Europe, but it is fair to say that if you are looking at the richness of the experience in Asia, you can also understand that the situation is complex. And unlike the case of, say, a fair share of Europe, which is dominated by the ECB and by the EU, the experience of most Asian countries is potentially more relevant to a standalone country like Turkey. Standalone in the sense that you are not part of the euro, and the association with the EU is very important, but not automatic. So here, I would like to conclude my short presentation by looking at whatever that we have seen in other countries. So what you detect here is the adjustment of the interest rate from 0 to roughly policy interest rate, roughly to 4 and above. Now, notice that if you are looking at the adjustment of countries of their interest rate in reaction to a sharp increase of the interest rate in the US by 4, so notice that there is interesting distribution. So this is Bangladesh. They adjusted maybe by half of this. India, slightly more. But almost all of the countries adjusted by a fraction of the adjustment of the US. There are, of course, exceptions. The Philippines adjusted still below the 4%, but closer. And Hong Kong also closer to 4%. South Korea by less, and the like. So the bottom line, and Japan, of course, the adjustment, you need magnifying glasses to see. But this is related to the fact that Japan is stuck with its deflationary bias due to reasons that are, I believe, not relevant for Turkey. After all, Turkey is a young and promising country. Japan is aging. So one lesson is that there is variety of experience in the adjustment. And one should ask in this context, to what degree there are some lessons for Turkey. And I'm sure that this issue is important if and when one would like to look at the experience of countries that, after all, a fair share of them are facing similar challenges of a relatively young population and dealing with new strategies in a much more complex global arrangements where the globalization is challenged from all directions. So let me turn now to the fact that important inflation meant also that currency defense may be important. Now, let me explain what's going on here. I mentioned before that the effect of the higher interest rate in the US is that the strength of the dollar increased. This implies, in turn, that other things being equal, the cost of goods that are priced and traded in dollar has increased for countries that are exposed now to effective depreciation of their currency. And one way to mitigate the inflation is if you are lucky enough to have enough reserves. And here you can see the currency intervention that we observe in terms of the percentage change in foreign exchange reserves during the 2022. So India used about 18% of its reserves, Hong Kong more. And if you're going through the list, the Philippines used like Hong Kong. New Zealand used almost 25%, Bangladesh more, and at the bottom, Pakistan used more than 50% of reserves. Now, this may help in the transition. And definitely some countries that started with high enough reserve position managed to increase the interest rate by less and maybe managed to mitigate the internal inflation by using reserves. My understanding is that Turkey is not exactly endowed with plenty of reserves. So, of course, this is constraining its ability to mitigate the process. And the outcome is also that the inflation in Turkey definitely has increased, not because of any problems of Turkey, simply because of the, if you wish, the global adjustment that was induced by the decision of the US to do what it takes to fight the ongoing inflation. And of course, the ECB followed. Yes, please.
If I may, actually, just to add one small point here, Turkey actually increased its reserves in the past 1 year. So they went up from about 109 billion US dollar, the gross reserves. It went up from that point to now it's close to 125 billion US dollar. So the reserves are up a little bit. But of course, Turkey used some other measures like the exchange rate protected accounts to deal with the exchange rate movements.
I'm aware of this, but the point here is that notice that countries that had plenty of reserves entering January 2020, 2022, followed the opposite policy. So I'm aware of what you are saying, but the point is that let us recall that the decision to increase the policy interest rate in the US happened in 2022. And countries that were loaded before with plenty of reserves are using their initial position to mitigate the inflation. So the point that I'm trying to make is, I think that Turkey increased their reserves, and I understand why. But because Turkey started with little relatively reserves, because some of the countries here in East Asia are sitting on, say, reserve to GDP ratio of 25%. So then they invested in the past in enough policy space. And of course, once that they are in Pakistan, if they are using 55% of their reserves, chances are that they will not be able to keep doing it. So in the context of Turkey, what you are saying may be good news for the future if the need will arise. And this is an important point that are related to the fact that I didn't mention before, that all countries are exposed now to tail risks. And from the point of view of, say, Turkey and all the countries that you see here, one tail risk is, of course, that if the US is deciding due to its own internal priorities to end the era of easy money and to increase the policy interest rate, this by itself increases the tail risk of global financial crisis. And even if there is no global financial crisis, it increases the tail risk that maybe there'll be a pressure, a threat of a crisis that will generate a rise in VIX, which typically is a signal of limited tolerance of the global investor to invest in foreign countries. And this by itself may generate capital flight and may terminate the ability of Turkey and other countries to get funding without paying exuberant costs. So one may argue that a mechanism to hedge yourself is precisely to accumulate reserves. So what Turkey is doing is the correct reading, I believe, of the exposure to tail risk coming from the decisions of the US and the ECB to end the era of easy money. But this also implies that for countries that are summarized here, including Turkey, which is not appearing here, there is a complex timing issue. First, when to accumulate reserves. Next, when to spend them. So countries that manage to accumulate reserves from the end of the global financial crisis until the COVID crisis manage to use this policy space. Countries that didn't accumulate enough reserves should now think about defensive strategy, because only time will tell to what degree there will be a global soft landing to the policies of the US. The Fed initially believed that they are credible enough such that there will be a global lending of the soft type. Now, I think that the market is more agnostic. There is debate, and countries that are that have accumulated more reserves, or countries that are that have accumulated deeper sovereign wealth funds, are better positioned to deal with this tail risk. Now, of course, the tail risk here is coming from the US, but nevertheless, this is a tail risk that may hit most emerging markets. So let me maybe summarize this by looking at the situation of Asia, and to a degree, it has some repercussion to all countries. So the feeling is that there will be end of Fed tightening around 2023. There is a debate to what degree it will be in the middle of it or the beginning. Time will tell. This by itself may be a good signal, assuming that we are not going to enter a global recession, the hard landing type. This will suggest also that more stable market conditions may mean that some central banks will see the opportunity to cut interest rate to support growth in 2023, potentially ahead of the Fed, with inflation having moved to more benign levels. Now, Fed tightening and weaker US demand will, of course, hurt Asian exports. The US is the destination of about 15% of Asian exports, while Europe absorbs 10%. So one can recognize that the situation now is mixed. You can focus on the half-empty glass, focusing on the tail risk facing China. People are concerned about the possibility that China that is switching now quite rapidly into a new opener approach towards COVID may face maybe a quarter or two of ugly adjustment. And time will tell to what degree the growth rate of China would recover, and to what degree the pending adjustment of the real estate sector may generate recessionary effects. So, and of course, China is a key player globally and in Asia. So this is a part of the empty half glass. The other, maybe fuller half, is that there is some hope that the inflation may subside at a rate that will imply that indeed towards the second half of 2023, we would be able to start, hopefully, exit from this said chapter of the global economy. Having said that, the biggest tail risk that I don't have anything to say about is the Ukraine and the complex of the geopolitical tension associated with the growing tension between Russia and most of the OECD countries, especially with the European countries and with the US. All this analysis is ignoring this growing tail risk because we should wait patiently. But if the situation will deteriorate, so all these scenarios will be underestimating the challenges. The second issue is that I believe that global warming and related tragedy of the commons of the global level are here to stay. And if you are looking at the research in the past, Professor Tirol made a point close to 10 years ago. They did the transition from the situation 10 years ago to the future. There is a period where all the countries that have oil and the like will try to adapt strategies that will maximize the revenue, believing that within 20, 30, 25 years, they will lose this source of revenue once that will adjust to better technologies. So we should keep in mind that if your planning horizon as a family man is for 50 years, and I hope that countries should down the road plan in this way, so there is the looming risk, which is by now not tail risk, because growing evidence suggests that it's here. And it's time now in the strategies of all countries, including Turkey, to think how to prepare for this challenge that, of course, may hit us at faster or slower rate, but chances are that within 50 years, we will live in entirely a new universe, and countries that will move faster will be better prepared. Also, if they will move faster in terms of generating the new technologies that will fit better in terms of the demands of the new global economy projected 50 years from now. Let me stop here, and I'll be happy to try to answer any questions and the like.
Thank you, Professor. Thank you so much for this insightful presentation and the talk. So from what I understand, you're basically saying that most of the policies, they may work, but there is certainly more to do beyond the current framework in Turkey and many other emerging markets, developing economies, including in high-tech sectors, savings, research development, and dealing with the current account deficits. In terms of unemployment and growth, Turkey is actually doing a little bit better than most of the developing world economies and even many advanced economies. And you also pointed to the tail risks in finance a few times. We actually have some questions from visitors in that line. So let me start with one of these questions, and if you would like to comment on that.
Sure.
So in terms of that macro and micro tail risks that were being ignored post the global financial crisis especially, we have this recent too big to fail phenomenon in the West in major world economies, and the crisis-prone banks, especially in Europe and the US. What would you think, or what do you think that tell us about the emerging markets, countries like Turkey? Does it mean any opportunities or new challenges for the newly rising world economies?
So let me maybe explain my perspective, which of course is debatable. Think about European countries. The tax level there in some countries is such that the average citizen is paying, say, 45 to 50% of their income which is the case in Denmark and Scandinavia. Now, this is a huge tax rate. Now, this implies also that the expectations from the public sector is to deliver a lot of insurance. And this insurance includes medical insurance, it includes daycares for free from age 0, and university education for free and the like. And it makes sense also for the citizens there to expect that if the regime is messing in terms of a regulatory structure of banking, if there is a banking crisis, then the expectation is not to allow the repetition of the Great Depression, but bailing out banks. So this is something that explains the fact that whatever is the rhetorics of the ECB, and whatever is the rhetorics of the Fed, if there will be a systemic banking crisis, there'll be this too big to fail. And the logic is simple. 200 years ago, in the US, we paid on average maybe 3% of taxes, mostly in the form of a custom, a tax on trade, to fund the seeds of the army. And nobody expected any deep insurance for such 3 or 4% of the income that we are paying to fund the military and the lean administration. And of course, by now in California, the tax rate is such that it's not yet at the European level, but it is approaching rapidly. So if you are adding to the federal tax, and so the bottom line, I think that for the OECD countries, the cost of paying high taxes by the average consumer is expectations that will be fulfilled. Now, the case of emerging markets is more challenging. But look at China. China is still not affluent, but I think that the speculation of the market is that if there will be a systemic collapse of the real estate market, the regime will do what it takes to do a bailout of the type of too big to fail. Now, Turkey may be in between maybe China and the US in terms of these issues. So my take is the depth of the bailout is frequently related to the quality of supervision before. And the US committed the sin of ignoring bank supervision under the management of Alan Greenspan, because Alan came from a tradition believing that the private sector shouldn't be regulated because this is happy capitalism. They don't want to adopt policies that may lead to their bankruptcy. And of course, this turned out to be a mistaken perception. And we know that if I am running a bank, there are various ways to rob the bank that in a way that will benefit me if there is no regulation. And if you are looking at the recent weeks, we have seen shadow banking activity of apparently related dimensions in the context of bitcoins and the like. But let me skip the details. So the bottom line, my recommendation to all countries is to regulate much more tightly shadow banking and to focus on regulation of all the systemic banks, including the mid-sized banks. Because mid-sized banks may be not huge, but if you have 100 mid-sized banks, if they move in the same correlated way, they may generate the next systemic crisis. And I think that a fair share of tightening of regulations has been achieved. I hope that also in Turkey. I am aware that the public debt to GDP of Turkey is relatively low. And this is important if there will be a need to bail out any systemic sector. But the best is to invest ex ante in mitigating the tendency of smart entrepreneurs that are part of the shadow banking to use leverage. And in this context, a smart entrepreneur without regulation may generate policies that at the end will have a possibility that head I win, if tail I lose, so then the taxpayer will pay for the loss. So this is in a nutshell the main point of Rajan in his very important paper in Jackson Hole. I think it applies to all countries and of course also to Turkey. And it's a challenge because you cannot claim that, hey, I reached nirvana with perfect regulation. My view is the opposite. I envision a day that we need to use big data and all this machine learning to generate stress tests on all the systemic banks at the end of each trading day. And then at the beginning of the next day, the stress test will force all the systemic banks to adjust. And presently, the stress tests, in my view, are more symbolic, but they are not really done to prevent a systemic crisis. But this is my my take on this.
Yeah, thank you, Professor. And another question we have here is about the debt GDP ratios. I remember in your earlier presentation, you were mentioning the post-COVID rising debt trend. And we also have this capital outflow trend. In Turkey, for example, we had a huge sum of portfolio capital flowing out of Turkey, which I think could be a good thing in the meantime in terms of decreasing volatilities. And we have some financial crises in some emerging market economies. There is this discussion about the original sin in especially in terms of the crisis in South Asian economies. They are dealing with a new currency or debt crisis. Some of them, they are running out of reserves, and there is this inflation surging all around the world, huge exchange rate volatilities. And again, in Turkey, actually, in the past 4 or 5 months, exchange rate volatility has been very, very low. But the question is, does Turkey, with a relatively lower debt GDP ratio, which currently is below 40%, does it mean any competitive or comparative advantage for a country like Turkey amongst the rising economies?
That's a very good question. And again, my assessment is that it's hard to say yes or no. And let me explain why. The fact that the public debt to GDP is relatively low suggests that if there will be any calamity impacting Turkey, and I can envision various calamities that are related to natural calamities or frictions, wars, and the like. So then internally, the relatively low public debt to GDP may allow a fiscal space that is very important in dealing with this emergency. Having said that, to my knowledge, the very low public debt to GDP still have not generated significant demand of international investors for some of this public debt. So this suggests to me that it's good news that the public debt to GDP is low in Turkey, because this allows dealing with internal funding of bailing out, or if you wish, dealing with natural calamities, wars, and the like. On the other hand, this is not solving the issue that we discussed before, how to fund all the nice projects that Turkey hopefully will invest in the future. And the reason is that at the margin, the government shouldn't fund the private sector or the quasi-private sector projects. And a lot of the funding is relying on external funding. And notice that despite the fact that the public debt to GDP of Turkey is low, still you are paying quite a high risk premium. So my point is that Turkey, to my knowledge, has not reached the stage of overcoming a fair share of the original sin. But of course, this is not a mystery, because if there is a high inflation and there is no signal at this stage that there is commitment to reduce the inflation, so then for a foreign party, purchasing a Turkish debt is very expensive or is risky. So they prefer to deal with funding that is of the type of costly, potentially very costly funding in dollar. So if you wish, lending to Turkey at a hefty risk premium. So my point is, for Turkey, it's a mixed message. It implies that if there'll be a way to mitigate the inflation and to increase the saving base, to mitigate the reliance on outside funding, good things will happen, and it takes time. So if you are looking, say, at the history of, say, Indonesia, Indonesia is poorer than Turkey. But by now, a fair share of the domestic debt of Indonesia is demanded by the international community. So there are various ways of managing the challenges of Turkey. But here, if you are looking at some of the countries in East Asia, Vietnam and I mentioned Indonesia, solve to a degree a fair share of what is known as the original sin, because they are viewed as the coming emerging tigers or quasi-tigers. And local investors so far seem to be happy to, if you wish, buy their bonds in local currency. So down the road, it will be a challenge for Turkey to find down the road a compromise that will move from the present configuration towards the configuration that some countries in East Asia benefit, because this implies also that the funding of all the infrastructure investment and all the, if you wish, the switch of producing some of the gadgets for the consumption of Europe and the US from China, say, to Vietnam, is cheaper than doing the same in Turkey, because of the fact that the credit risk of Vietnam now is lower than of Turkey. So everything here is related to trade-offs. So I'm not saying that Turkey is doing something wrong or right. I'm saying that if you are looking at the variety of experience in Asia, you can see that countries are choosing different strategies, and it'll be up to the taste of the regime and the country to choose from this menu what is the better configuration. I fully agree that Turkey has the potential of doing a lot of good things. The question is, to what degree the low public debt to GDP is the solution to this. I am agnostic. I'm not sure. Because at the margin still, a lot of the projects that we are dealing with will benefit by joint ventures with foreign parties or by foreign funding. But the risk associated with political instability and inflation above the global average may imply that the cost of this strategy in Turkey is higher than, say, in Indonesia.
Thank you, Professor. So the picture does look good, but in terms of the cost of financing, there is still a lot to do, you're basically saying. So thank you, Professor. It was indeed a great honor to host you tonight, and a privilege listening to you. We don't want to keep you here longer than we planned earlier. We're planning to be here for about an hour. So thank you so much for all you have shared with us tonight and for taking the time to join us tonight or the very morning as it is in California.
So thank you very much. And let us hope that the more optimistic perspective will prevail.
Thank you. Yeah, sure. We look forward to having you another time, having another opportunity to host you sometime in the future. And for all others that are following this panel online, we would like to thank you all. And we're hoping to see you again. Yeah.
No, it will be my pleasure.
And we're also hoping to see all the followers during our upcoming panels as well. We wish you all a great night and rest of the week. Bye for now.
All the best. Bye.